Let's do it, folks. It's Friday. Good morning. Welcome to The Street today, here for Post 35 on the floor of the New York Stock Exchange. It is Friday, February 24th. At least sources familiar with the situation tell me it's Friday. I'm your host, JD Durkin. We're about an hour or so into the trading session, and losses, well, they've been on the board and they've been accelerating a bit as investors react to hotter than expected inflation data out earlier today. PCE, or personal consumption expenditure data, coming in at 0.6, higher than the Street's forecast of 0.4. We'll get into all that and so much more on the broadcast this morning. Speaking of the broadcast, what's on the show today? Let's take a look. We'll talk inflation as the Fed's preferred inflation gauge comes in higher than expected. Plus, we will talk Fed expectations as the central bank contends with a red-hot economy. Oops. And finally, we'll tell you why Boeing is suspending deliveries of one of its most popular jets. For more on those stories and so much more on this Friday, we now welcome in Mr. Martin Baccardax, our senior editor and chief markets correspondent. Happy PCE Day, Martin.
Those who celebrate, as you often say.
Yes, for sure. I don't know. Happy, I guess you put with a little asterisk depending on who you are. Coming in hot here today, my friends. Above expectations. What do you make of this report?
Well, it's interesting that you describe it that way, because I think, once again, we sort of have to look at the parallel dimensions when we're talking about these inflation numbers. Because certainly on the bright side, for the most of us who are walking around in the world, when we see consumption rising, when we see incomes rising, when we see spending rising, that all should suggest a healthy economy. A healthy economy is what we are all striving for. So to some degree, the numbers were happy because they reflect the fact that the U.S. economy is ticking along at a very healthy pace. Atlanta Fed's GDP now says that's about 2.5%. It ended the year with a 2.7% pace, so that's nice momentum coming into 2023. There's more bets that we might be able to avoid recession along the way. And of course, we had that blowout January jobs number and the slowest number of weekly jobless benefit claims in about 2 months. So all of that together, JD, should be very positive. The one caveat against it, of course, is that with that growth comes faster inflation. And that is really the pivot point for the markets today. The core reading of that PCE price index, which is what the Fed pays the most attention to, sped at the fastest month-on-month pace since June. It doesn't seem like much. It's only 0.6%. But nonetheless, it was well above the Street forecast and actually accelerated from the month of December. So the Fed is worried that the sticky inflation that they've been warning us about is not only staying put, but slowly rising, and that's the last thing they want to see. So as a result, people are betting that the Fed might have to go faster and harder on rate hikes to tame that inflation, and may have to hold those rates in place for a longer period of time. And collectively, that's what's putting pressure on the stocks today.
PCE data comes from the Commerce Department as opposed to a few other data points we follow throughout the month, like CPI and PPI. Those come from the Labor Department. Give us your sense. Once again, I like to revisit this conversation for someone who wonders, why is this the Fed's preferred gauge of inflation? Why does the central bank pay such close attention to this number, PCE in particular?
It's a more nuanced measure of consumer spending, JD, and it comes together with numbers on both incomes, consumptions, and savings. So it gives a better collective view of the strength of the American consumer and how he or she is being affected by increases in base prices. And what it also does is sort of, it moves from month to month in terms of the way it's calculated based on changes in American consumption patterns. So it doesn't stick in the same way that CPI does in terms of measuring the price of a particular good that might just not be available or might not be part of the regular purchases. The CPI isn't rebalanced in that way on a consistent basis. And sometimes, as a result, it can give readings that just aren't reflective of what's happening in the real economy. The PCE price index is meant to sort of make judgments of that nuance and that change in consumption patterns based on available goods, and even based on the way that people's daily activity changes on a month-to-month or even year-to-year basis. So it gives a better, not only collective view, but a specific view of how we're spending our money and how we're impacted by price rises.
We don't always do this, but on a day like today, it's worth, from time to time, doing a kind of a market check as the show goes along. And for just a perspective here, I mean, the Dow is down now 500 points, 1.5%. S&P is down Make sure these numbers are right here. I'm just going to look at the big board. Dow's down 1.4, S&P is down 1.5. We are at 39.49 now for that level. We always talk about where it is in relation to the 4,000 level. We're also seeing a rise in the 10-year. And I got a question on Twitter this morning. I want to pose it to you. Why would we see a rise in long-term yields for bonds off of the inflation print? Can you give me your perspective on that for people that are wondering, sort of what that relationship is? Obviously, we know there's an inverse relationship between the value of a bond versus its yield, but we are seeing that yield at least tick up slowly. What's your sense on that particular metric we're seeing since the number came out 2 hours ago?
Well, I mean, I think it's a fairly good question because sometimes I think in financial markets, we assume that people understand the mechanics of a lot of these investment vehicles, and they can be a little bit tricky, but once they're explained, they actually do make a lot of sense. Inflation, JD, is the enemy of bonds, and here's the reason why. Inflation erodes the value of future payments. So a 10-year bond is going to pay 20 coupons over its lifetime and then give you the money back when the bond matures. Now, each of those coupons, of course, is further off in the future. So when you try to judge their present value, you have to do it with what's called a discount rate. And that way you can get an arithmetic figure of the price of the value of all of those coupons plus your maturity payment. You boil that all down and you get a bond price. Now, the higher that discount rate, the lower the bond price is going to be. So that's why you will see bond yields, which move in the opposite direction, rise as inflation either increases or inflation expectations increase, and perhaps even thirdly, when Fed rate expectations increase. So you get that inverse relationship, but for the most part, it's simply investors doing what's called a cash flow discount with a higher rate. And when you do that, if you remember your algebra, the ultimate price is going to come down, and that's why bond yields rise.
All right, so let's talk about, thank you for that perspective, by the way. It's a good question, and it's one of the more important metrics that we follow as long-term bond yields can be a bit of a crystal ball, perhaps in terms of where investors are moving their money, either to presumed safer investments like bonds or riskier in stock market or other elements. I do want to ask you more specifically about the Fed here. Surprise, surprise, today ends in Y. We're going to talk about the Fed. How do you expect the hotter than expected print today to impact the next move at their March meeting? There's always a version of this question I ask you, but in today it's in light of PCE data. So what do you think?
Well, I think there's two dimensions to that, JD. The first is that certainly the bets on a 50 basis point rate hike next month have started to accelerate as a result not only of the data that we've seen today, but the collective series of numbers for the month of January, and indeed the fact that we have decent momentum in the economy going into February. So the last I checked, the Fed Watch is putting the probability of a 50 basis point rate hike at about 35 to 40%. And the bulk of the betting, of course, says that the Fed will just raise it by 25 basis points and carry on doing that for the next 3 meetings. But the second dimension that I wanted to mention, JD, is that there's actually now very small but growing bets that the Fed will actually add a 4th rate hike to that cycle in July, and that would take the Fed funds rate to a range of 5.5 to 5.75%, and that would be about 25 basis points higher than current projections. And again, that number is small, but it is growing, and of course it was growing today on the back of what we saw from the PCE inflation data. There's a great debate as to whether these numbers are sustainable. There's many people who are saying that all of the inflation figures are simply echoing that stronger than expected activity over the month of January, which is helped in part by significantly warmer than expected weather. So if that weather were to turn, or if that momentum were to carry through, you can imagine inflation slowing very quickly, particularly when it's measured on an annualized basis. It's important to remember that we look at 2 inflation numbers. We look at month on month and year on year. The year on year numbers are going to start to come down very quickly over the next few months. There's going to be some noise in the monthly readings, but if we do get that deceleration as anticipated, in the headline year-on-year readings, you can imagine some of those rate bets are going to fade along with it. But we still have a lot of data to plow through, certainly until March and most definitely until July.
So Martin, the last time you and I had this conversation about CME Group's Fed Watch number, the number for 50 basis point, the likelihood was 20 to 21%. And I had to check it after your last response. I said 30, and you're exactly right. It is now 30%. Give us your sense on what has really just changed in the last I forget if the last time I had you on the show was yesterday or the day before, because time doesn't make sense to any of us anymore. But it was really just a few days ago. The number was quite a bit lower. What has shifted here this week? It's a shortened trading week, but clearly there's a lot going on.
Yes, I think simply the fact that, well, certainly today's PCE data, which accelerated faster than expected. We had the harder than expected CPI data as well. And there's also been, of course, this really, I wouldn't say surprising, but certainly unexpected pullback in weekly jobless claims. That has suggested that the February payroll number will be stronger than expected. More jobs equals faster wage growth. Faster wage growth, of course, feeds into inflation. So that's part of the reason why these 50 basis point rate hike bets have been developing. But secondarily, JD, we had commentary not only from Loretta Mester, the Cleveland Fed president, but James Bullard as well, the St. Louis Fed president, both of which said they could advance a case for a 50 basis point rate hike if they were pressed to do so. Mester, in fact, said she made that case in the February meeting. The Fed minutes indicated that a few Fed members made a 50 basis point case. In Fed speak, that generally means more than two. So there are others inside the Fed who are going to potentially make that 50 basis point rate hike case again in March. That, set against the faster data, is why we're seeing these bets accelerate and why the expectation is as high as it is now. And you talk about 20% last week. I think it was in the low single-digit percentage only a month ago.
And then before that, I think the possibility of 50 basis points, given what we've seen. I mean, of course, we had the era of, I almost call it now the short-lived era of disinflation commentary, which is at least the last FOMC meeting. And the idea of 50 basis points, I think, was kind of off the table. To your point, I mean, single digits. And now, as we're checking in real time, 29.9%. And that's certainly a number we're going to follow very closely. After 8 consecutive rate hikes, Fed's still contending with inflation here. Any sense, Martin, that the Fed's rate hikes are not yet making much of a dent in the economy? I know they kind of get criticized sometimes for being backwards looking, but we do hear from some regional Fed officials who say, well, look, we have our sources, we have our contacts, we're actually much more finger on the pulse of the numbers today than some of our critics might otherwise think.
Yeah, I can certainly see why that argument would be put forth. I think ultimately, though, JD, we just have to look at the fact that the lag effect from rate hikes is quite long. It can be as much as 12 months and sometimes as much as 16 to 18 months. And the biggest rate cuts only came in the latter part of last year. So from an economic perspective, at least when you're doing the slide rule, you could say that we just haven't felt the effect of the tightening of the second half of last year, and we're only seeing the effects of the first half of the year's tightening, which was very mild. The first increases from the Fed, which were around this time last year, were only 25 basis points. This time last year, JD, the Fed was still executing quantitative easing. So we have still some months to go before we are likely to see the full effect of Fed tightening, and months after that before we're seeing the full effect of the jumbo rate hikes that we experienced in the fall of last year. So that might be part of the reason why. I think there are other people, and I tend to be in this camp as well, that say interest rates are simply a blunt instrument and probably not designed to tame the kind of inflation that we're seeing, which for the most part is as a result of the supply chain disruptions that were experienced as a result of the pandemic and the energy price spike, which came after Russia's invasion of Ukraine, which today is the 1-year grim anniversary. So to some degree, when you look at both of those conditions, the lag time in which we are likely to see the effect of the hikes and the fact that the hikes themselves are a blunt instrument against very specific inflationary pressures, perhaps that's why the numbers are still as elevated as they are, and there's still a great amount of discussion as to when they're going to slow back to the Fed's 2% target.
We heard comments from Cleveland Fed President, Loretta Mester earlier this morning, as I know you know, but you actually tweeted a pretty interesting take on the interview itself, and I hope you don't mind, but we do have it pulled up, because I like kind of contrarian takes on this, and you write, do Fed policymakers like Mester or St. Louis's Bullard really need to be out and about in the field, seemingly all the time commenting on rates in the economy? It seems needlessly muddying, and I wonder if your view on that, Martin, comes from the fact that they are simply non-voting members, or that even if they were voting members, kind of additional commentary like this, or at least paying extra close attention to it maybe doesn't really serve any of us in the short term or long term. I wonder if you're willing to expound on that, because I liked the take.
Yeah, a little bit of both, JD, to be perfectly honest. And I hope people don't interpret this as specific attacks against Bullard and Mester. I mean, they see themselves executing their task as Fed presidents, with a great deal of honor and with a great deal of respect. And I don't necessarily mean to suggest that they're doing anything wrong. But I do wonder if our constant focus on the specific wording of statements or comments or discussions that are brought by these Fed presidents and others are not, as I say, sort of needlessly muddying the waters. To some degree, back in a previous generation, when I first started doing this in the early 1990s, the Fed policymakers did not speak at all. There was generally the one press conference after the rate hike. The questions were put to the most senior members of the Fed, either Volcker or Greenspan or you name it. And that was it. It was all quiet on the Western Front for the most part in between meetings. Now, basically, we have Fed speaker headlines virtually every day. The difference, I think, JD, between here in the United States and in Europe, where European central bank speakers are also very active, is that the communications policy there is more directed to regional newspapers and media outlets. And they do it for a very specific reason. They want to be able to explain monetary policy in a very straightforward and basic way so that member states around the European Union understand what it is they're doing and see its influence on their specific economies and their daily lives. Where it manifests here in the United States is that this commentary is far more focused on financial markets and really just goes straight over the head of most American citizens who don't understand the jargon and who aren't watching the markets on a day-to-day basis. So to some degree, the messaging doesn't really reach what should be the target audience and really just tends to placate financial markets. And that's why I think it muddies the waters in such a way. And I do wonder if that communication policy doesn't need a rethink.
So, like I said, I really appreciate the take, and I appreciate that final note there. And I wonder if you are like me in that you get frequently asked to explain what these admittedly pretty complicated business headlines mean for people in your family. And I just speaking from my perspective, my mother will ask me, my best friends will ask me often, what does this mean for me? Can you break this down into like human speak? And I recognize that there is, and I remember this from my years covering policy and government in Washington, there's a lot of language, and we kind of keep it, we like this separation almost between the layperson's understanding and the intentionally complicated jargon of the world that we operate. And I recognize it back here covering markets once again. I recognized it down in DC when things were needlessly complicated. And I wonder, do you often get personal questions in your life say, hey, Martin, what does this mean?
Very often, and actually it's interesting, not necessarily with respect to what the Fed is saying or doing, or indeed sort of where interest rates are, because quite frankly, JD, almost exclusively the conversations I have with people are absent any understanding of where the Fed funds rate is right now. And I don't say that pejoratively. There's no reason for anybody to understand where the Fed funds rate is, because their personal experience is more about their mortgage rates and what kind of savings rate they're getting from the bank in which they deposit their money, and hopefully what kind of return they're getting on their investments. For them to get down into the nitty-gritty of Fed funds rates and bond yields and all the rest of it is simply just not part of most people's lived experience. The most questions, or the most likely questions that I'll receive, tend to be focused on two things. How fast is inflation rising, and is the economy growing? Sometimes that filters into the job market as well. But it's interesting that you asked me that, because only yesterday we had a workman here at the house doing some bits and pieces. And he made the comment to me that he felt the economy was in recession right now. It was kind of incumbent upon me to explain to him that actually we had some data today that says it isn't, and it's growing quite strongly, but he wasn't buying it. He was saying, in his experience, in what he's seeing around this region in the southern part of Florida, he feels that the economy is in recession. And who am I to say that it isn't? Because most people's lived experience has a narrower perspective than the one that we tend to enjoy here, looking 360 degrees. So to your question, I get more commentary about the economy than I do about the Fed.
No, I really appreciate that. Yeah, granted, not very many people ever ask me about the latest with regards to the central bank outside if they hear me talk about it and they say, what is that? Why do I care? But that's interesting, though. I always appreciate that because you do bring really good anecdotal reporting in terms of conversations like that. And ultimately, not to bring this back into politics, but that's how people vote, right? You vote
Yes.
oftentimes based on your feeling of the economy. Like the numbers can tell one story, but who are any of us as journalists or anyone else to kind of personally disagree with someone who says, well, listen, I look at my numbers. I know my challenge is to hire. I know my challenge is to find a job. The data can tell us one thing, but ultimately, if that's how someone feels, that person may ultimately go to the ballot box and vote based on that personal feeling. So I appreciate that.
That's exactly
More
right.
broadly,
We call it, I call it the statistic of one. Essentially, we can talk about numbers and data and percentages and all the rest of it, but generally people experience their lives through the statistic of one. How am I being impacted? So to your point, that's exactly correct. And that is what people will take either to the ballot box or to their spending habits or to their saving habits or to their investing habits. And that is really the challenge of both Wall Street and Washington, to sort of explain around that.
yeah, granted, Wall Street and Washington are never on the same page. They don't speak the same language. They don't understand one another. And we're still kind of early in this 2024 election cycle. But as you know, Martin, as well as anyone, we're already kind of in the swing of the presidential cycle. We're not quite yet at the campaigning level where candidates or would-be candidates are really weighing in on economic nuances. But man, I'm very excited for when we get to that debate. We're still a while off. They're still just kind of testing the waters for now. But I hope hard questions on the economy are coming. Stocks are set to close out here, of course, another week of declines after the dynamite January that we had. Are there any other main factors dragging on sentiment that you think we have not already talked about here on today's show?
I think really it is such a Fed-defined market at the moment that the only underpinning is really whether or not investors see earnings strength sort of maybe improving if the economy were to stay at these elevated levels of growth. I guess to say, in other words, we could argue that forward earnings projections were based on the fact that the economy might tip into recession over the first half of the year. Right now, I'm seeing more and more commentary that suggests that might not happen until the latter part of 2023 or potentially 2024. So that could cause a revision in near-term earnings projections, and that could give stocks a bit of a lift. But what I'm seeing more than that, JD, is a significant drive into fixed income, not only from retail investors, but from institutional investors as well. Flows into bond portfolios have risen now at their strongest pace in about 18 months. And that's really notable when, as the viewer suggested, 10-year yields are creeping towards that 4% level. Even shorter-term Treasury bonds are offering yields and returns that are very competitive when compared to the risk that you take going into the stock market. And that could engender all sorts of switches with respect to portfolios, again, at the retail and institutional level. So the bond market is suddenly going to play a significantly more important role in stock performance if we are to stay at these elevated levels of growth and inflation, and indeed if yields can offer that kind of competitive return compared to the stocks. Because again, it has to be remembered, you buy a 2-year Treasury bond, you are not going to lose money. The same cannot be said for going into the S&P.
Absolutely. One other data point on the day that I was just reminded of that I did not ask you about, and I believe we got the information within really just the last little bit, is of course consumer sentiment. We track the numbers out of University of Michigan pretty slowly. We had some revisions higher. I don't know if you've been able to see the numbers yet, but do coming in a little bit higher than expected. Either if there's anything you can comment either on anything you've seen today or in general, why that is such an important metric on top of as if we didn't already have enough on our plate in terms of data points for a 4-day work week. But this is an important one as well. Maybe not quite the headline grabber that PCE is, and understandably so, but it's an important one, right?
I think so, JD. And it just reminded me of something that I was thinking about when I was talking about the difference in communication between the European Central Bank and the Federal Reserve. I think one of the most important dynamics in U.S. investing is the fact that most people have very significant big ticket items that they need to finance and budget for. Your child's college education, your health care, and your retirement. Those are really significant expenditures. In Europe, nearly all of those are covered by the state. University tuition is very, very low, and in some states, in some European countries, free altogether. Healthcare, of course, is part of your basic tax program and isn't something that you pay out of pocket, and neither is retirement. So in Europe, you're not necessarily as invested in the stock market as you are in the United States for those three reasons. So I mention that because consumer sentiment tends to be very closely related to stock market performance. And of course, we can understand why, because people need to be invested in order to fund those three significant expenditures. So if you've had a decent start to the year, as we've had in stocks, consumer sentiment is going to rise. And it's only going to be supported by the stronger than expected January jobs data and the fact that we're seeing consumer spending hold up really well in the month of February as well. So that number ticking higher, I think it got to 66 or 67 points this morning, if I'm not mistaken, doesn't really surprise me, but I don't necessarily think it reflects much more than the fact that people's sort of perception about economic strength is probably more tied to financial markets here in the United States than anywhere else in the world.
And before we know it, to the point about jobs, I think we get the February jobs number. It's not the first Friday of March. Is it the second Friday of March? Is it March 10th? I think there's a little bit of a jump for February. Maybe I have that wrong.
No, I think you have it right, and I can't explain why. Typically, it is the first Friday of the month, but from what I've seen from a couple of different sources, is that number will come out on the 10th of March.
Yeah, so that means we are 2 weeks away. So 2 weeks from today, we'll be having this conversation to see what happens after the Dynamite 517 figure, which of course has been top of mind, highly referenced, came out after the last FOMC meeting. But will be something for Fed officials to contend with as we move on to next month. Can I ask about the dollar index real quick, too, while I still have you? Dollar index climbing to highest level in over 2 months.
Yeah, big jump up. It's going to move in unison with Treasury bond yields for the most part, and will reflect the price of money. I think to some degree also, though, JD, the move today is perhaps more tied to a weakening yen than anything else. To get down into the dirt a little bit, there's a new Bank of Japan governor who's going to take office in April. And he made some comments to Parliament this morning saying that he expects a low interest rate policy to persist in Japan as a result of the fragile nature of that economy, which it's always worth remembering, JD, is the third largest in the world. And even more importantly, from the American perspective, they're the biggest holders in the world of US Treasury bonds. So he's going to hold rates lower as a result of that fragility, or what he sees as fragility. That's weakened the yen, and the yen is an important component in the basket of the US dollar index, which is a big part of the reason for the jump today, and also the movement in Treasury bond yields.
Absolutely. Appreciate the context as always. Let's move on to our rapid fire section now, if we can. First up, grounded. We do want to talk Boeing. Why is Boeing halting production of the 787 Dreamliner?
This company has a hard time getting out of the way of bad headlines, doesn't it? Essentially, what Boeing is saying is that a bit of a fuselage in the 787 Dreamliner isn't fitting the way that it should, and that there were errors discovered in some of the safety checks. And they say Spirit Aerosystems, which is the component supplier, is responsible for the error. Spirit Aerosystems, of course, says it is not. So there's a back and forth there. But the FAA has essentially said, until you guys get this sorted, you cannot deliver these 787s, and they haven't come off the assembly line since the 26th of January. And of course, they really only began redelivering these planes in the summertime after the FAA signed off on it. So you can understand why this is a material impact on Boeing stock today, which is also being dragged down by the broader loss for the Dow Jones Industrial Average. But it kind of comes at a bad time because Boeing had a decent fourth quarter result and actually had recently a really big aircraft deal with Air India, which investors saw as very positive in terms of their order book going forward. Today's activity and today's headlines just simply once again disappoint investors who've been very patient with this plane maker for a number of years now.
All right, next up, I've been excited to ask you about this one. Shares of Beyond Meat really popping on the day. What is behind Beyond Meat's stock surge?
Well, I can't explain why it was up. I saw it up 30% at one stage, JD, prior to joining the program, and I can't fully explain that. But nonetheless,
It's
they
20,
had
23% now, yeah.
Goodness, that's really, really high. They had a better than expected fourth quarter. I mean, they had revenues in the region of $80 million, and that was ahead of street forecasts. They're cutting expenses within the business quite sharply, and they expect those expense cuts to continue into 2023 by around 22%. So cost discipline and the fact that they see revenues rising over the full 2023 year are giving the stock a bit of a jump. But they've had a hard time sort of coming up against food price inflation here in the United States. Their products are a bit more expensive than traditional offerings, and therefore they've had a hard time as a result of people trending down as a result of their food budget spending being impacted by this decade's high inflation. If that were to abate, you could imagine that people will come back to some of the plant-based products. Maybe that's what investors are seeing in the numbers that we got last night. I mean, anecdotally, JD, I like Beyond Meat stuff. I don't know if last night's numbers would, sort of compel me to add 25% to the stock today.
I was going to ask if you are a fan of the products themselves. Not everyone is.
I really do.
From time to time.
It's just fantastic. The burgers have been fantastic. I think it's a really important development in basically the food sector writ large, in the sense that if we can establish plant-based food to challenge some of the more traditional foodstuffs, which have significant environmental impacts, that can only be a good thing. And again, anecdotally, I think they taste quite nice.
Yeah, absolutely. I'm there with you. Vegetarians usually view these products as kind of indulgence items because they're certainly not perfect, but it has been, I think, welcomed by many to see some of these companies go public and have more options out there. Okay, number 3, hot ticket. Let's talk live. Sorry, go ahead.
Very quickly, do you know what they're made of? What the most significant composition of most of the Beyond Meat products is?
I would assume the answer is soy or pea protein, but maybe it's something else like methyl cellulose. I don't know.
Yeah, you're absolutely right. It's pea protein. Isn't that interesting?
Pea protein. Yeah. I'm pretty well versed in what these products end up going for if they're not going for traditional animal byproducts. I've done a lot of studying into them, so it is interesting to see and been interesting to follow the stock price for a company like that. It's a very wild ride. I was not expecting it to have the day that it did today. Okay, on to number 3 here. How did Live Nation perform in the fourth quarter? Hot ticket indeed.
Really well, and indeed over the whole of last year, JD, it had record revenue, 16.7 billion in revenues. It was a 44% year-on-year increase, and of course this comes at a time when not only lawmakers but virtually everyone in the country has been a little bit angry with the company, which owns Ticketmaster, as a result of that fiasco with the Taylor Swift the concert event earlier last year, and some of the promises that the company has made with respect to the Beyonce tour, which is set to begin in North America sometime in the summer. Live Nation says it wants to crack down on a lot of this, not only the ticket speculation, but the bots that sort of come in, purchase tickets and then sell them on at a profit. But they're going to have, I think, a very difficult time with that because supply and demand in the entertainment space is no different than anywhere else in the US economy. And by Live Nation's own description, they are seeing no pullback of any kind in demand for those live experiences. Obviously pent-up demand to some degree from the pandemic, but also just the fact that younger people's consumer habits have changed so significantly that they purchase experiences over goods, and that tends to manifest itself into things like live concerts and festivals and all the rest of it. So Live Nation is well positioned, but they are also in a odd position at the moment because lawmakers are looking at them quite closely, and ticket purchasers have been increasingly frustrated with some of their tactics. So managing that will be as difficult a task as making sure that they can give people what they want when demand is so high.
A little bit of a goofy side note on that story are all the lawmakers, both Democrats and Republicans, who insisted on quoting Taylor Swift during those Ticketmaster hearings. I expect that to continue. Now let's try and have their little cute moments where they're up there on the dais. A fantastic show, no shortage of things to talk about. My best to you for a happy Friday, well wishes, and for a great weekend, the great Martin Baccardax. Thank you, my friend.
Thanks, JD.
All right, folks, that's going to do it for The Street today on this Friday. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you on Monday.